The economy's in a pretty sticky situation right now. So we have stagflation or worries of stagflation. I want to break down monetary policy kind of as a whole. It's kind of like because it's super crucial. Like whatever the interest rates are, the current monetary policy, it impacts everything in terms of our mortgages, or how much it costs to borrow money, the value of our money itself, credit card costs, everything. So I want to give a quick, like a 101 on monetary policy here. Just keeping it super digestible, let's say. No big words, and just put it in simple terms so you can actually understand it more and it's not too daunting, let's say. So monetary policy is literally just the way that the central banks maintain stability across inflation and growth. It's really that. It's really the balancing act, like balancing if they do deflationary deflationary action, or let's say they can do contractionary or expansionary. When they're doing expansionary, it's going to cause GDP and growth to rise, people will be spending money, but that will cause inflation. So then they'll have to do contractionary or deflationary action, hawkish action, to then curb that inflation. So it's always just this balancing act. It's like pumping a bit into this one, and then as this one gets too big, then pumping back, boom, 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 boom. Just maintaining that equilibrium. Yeah, stability really. So they control it in different ways. The ways they do it, mainly, the two primary ones are like quantitative easing and quantitative tightening. So basically just creating or reducing the money supply, and then interest rates. So they'll increase interest rates or reduce interest rates. They can also do like future pacing, so make some clear statements as to what the future monetary stance is going to be. It's a little bit less important right now. And then also regulatory interventions, which again are in more extreme cases and not really important now. The main ones we need to be keeping an eye on are the quantitative easing and tightening, so expanding and contracting the money supply, and the interest rates. So right now it's a bit tricky because we have slow growth in the economy. Let's use, well, again, we've got slow growth in the Eurozone, GBP, and the US. So in these cases, what the normal government interaction, so not the government, the central bank's intervention would be to cut rates, to stimulate spending, stimulate growth, get some more money flowing around, because the numbers are slow. The growth levels are shrinking, let's say. But when we do that, so when we do dovish monetary policy, when we cut interest rates, put more money into the economy, that increases inflation. Right now, we need to stimulate the economy, so we need growth to rise. But as growth rises, so does inflation. But we can't do that because inflation is already rising. So if we stimulate the economy by printing more money, that's going to cause inflation to go through the roof, and then we could get hyperinflation. So we're in this really tricky period of like stagflation now, whereas we've got low growth and high inflation. So the yield curve has inverted. So without getting too technical, the cost of borrowing, like a short term, so if you're going to borrow money, let's say, if you're going to borrow that money and say you're going to pay it back within 1 year, person A is going to pay it back within 1 year, person B is going to pay it back within 5 years. Person A should get a cheaper cost of borrowing because they're going to pay it back sooner than person B, obviously, because there's more risk. There's 5 years worth of uncertainty. Things could change. So it's a very bad sign when person A, who's going to pay it back within a year, it's more expensive for him than the person B with a 5-year loan. I hope I'm trying to simplify it very much. But basically, when short-term borrowing becomes more expensive than long-term borrowing, this is a very bad sign. It's a sign that the markets, the economy anticipates slower growth for the foreseeable. When this happens, so this is called the yield curve inversion. When this happens, this is a sign that central banks should then intervene and stimulate that economy. But we can't do that now because of the war that's going on with Iran. That's causing oil prices to rise. Oil prices rising is inflationary, so the cost of everything rises because all goods and services like arrive via plane, train, or boat. All of those use oil. Production costs use oil. The price for everything goes up when the price for oil goes up. So we have these metrics that are pointing towards recession, towards slowing growth, towards the need to actually stimulate this economy. But we can't stimulate the economy because of the rising risk of inflation. I do want to talk about how it affects bonds as well, but I don't want to overcomplicate this video. I want this one to be pretty, how long are we? We're 6 minutes in. Just briefly, I'll just tie it to bonds briefly. So, or maybe no, I'll leave it. I'll leave that. I'll put that in another video. Just keep these bite size. Yeah, that is monetary policy in, I guess, relative terms to how it's linked with now. I'll probably cover the bond one in the next one.